All right. Well, Diane and Tim, correct? Is that you, Tim, down there?
You're on mute.
Yeah, I see you muted. Yep, for sure. I understand you guys have been helping agents out of our Southwest. Hey, Tim, there you go. It looks like you're unmuted. Awesome. Good, good, good. Kathleen was catching me up a little bit. You guys have been in a pretty close relationship with our Southwest office. Is that correct?
Yeah, I just call it the Scott and Charlie and Jeremy group, but yeah, everybody kind of in the Milwaukee Metro, Brookfield, Germantown, all of those guys.
Got it.
And then we've done a presentation recently for the Madison KW group that went real well.
Okay, well, we're kind of in between. I run the Lake Country office, part of Charlie's group. So certainly excited to have you guys do a presentation today. And I hope that some of my agents jump on too, because gosh, we need the information that you have to share. Looking forward to the session personally too. So thank you guys for sharing. I appreciate it.
And I'm sorry, your video just says
you have no idea who I am. Yes. My name is Diana Gabler.
Okay.
And I'll put it in the chat. It's a, like I said, I'm the team leader out at Keller Williams Lake Country.
Which is in what communities?
We're in Heartland, right on Capitol Drive in the main drag here, but we service Waukesha, Heartland, the Lakes area, Oconomowoc, kind of everything Heartland, and then we have a sphere and then a little bit west. So
okay.
Awesome. Good, good. Well, we'll give a chance for a couple more people to come on and
who is just I see who Kathleen Wooten is, and who is the lady in KW Milwaukee NS.
My name's Caitlin. I work out of the innovation office in Tosa. I can go ahead. Do you want me to admit the agents in?
Yeah.
Well, are you guys ready? Diane, yeah?
Yep.
All right, let's do it. Awesome. Hi, everybody.
Afternoon.
Hello. Ann Kleber, your background looks different than it did this morning. It's good to see you again. Jordan. Awesome. Amber. It's good to see you guys. I think we're bumping right up on, it is 2 o'clock. I know some people are going to be connecting here while we get going. There are always a handful of stragglers, but I really do like to honor everybody's time and thank you all for showing up. I'm a big fan of cameras on. I just think, you know, as a support for our presenters, it's really, they're giving us a lot of information. If we can support and if we have questions for them, they can see our feedback and use the chat for sure. But I'm sure these guys are totally down with interactive, which I appreciate. We're very excited to have Diane and Tim here with us from MBE CPAs. They've been longtime supporters of Keller Williams in Southwest, downtown Milwaukee, Germantown, you know, all that good stuff. We're kind of introducing them out here in the Lake Country area as well. And I know that they have a lot of expertise to share with us today. So Diane, Tim, I'm going to stop talking and let you guys take it. Thank you guys for being here today.
For inviting us.
Yeah.
I want to echo your sentiment about the cameras and even to unmute your mics while we're talking. I like to think about these as a conversation amongst friends. I think we can bring you when you interact with us and ask questions and help us to understand the things that are relevant to you. Tim and I could talk for hours and hours and hours about taxes if you want to. So we're here today to talk about optimizing tax laws and different strategies for people who are in the real estate industry. And that's kind of excited as investors.
Hey, I'm sorry to jump in, Diane. Your mic is cutting in and out.
I'll try to reposition it. Is this any better?
Yeah, much better. Thank you.
Okay, thanks. Sorry about that. So we're here today to talk about tax strategies for the real estate industry. I think that there are some tools inside of Zoom that'll let you raise your hand. Does anybody here have investment property in addition to being real estate agents? Safe to assume you're all agents. Yes. Any real estate investors as well?
If not yet, there are some aspirational investors on. I know that. So we'd be
Great.
interested in hearing for sure.
Perfect. So first we'll tell you a little bit about our firm. We are MBE CPAs. We are what are we now, Tim, 10, 11 offices? I can't quite remember.
11.
We're situated throughout the state of Wisconsin currently. We have employees all over the world. You can see our office locations here. Our website is mbe.cpa. Tim, I'll let you jump in on the family of companies. You do a good job with that.
Yeah, so one of the things that's unique about our firm is that we operate with several affiliates. A traditional CPA firm that does, nationally ranking, we're in the top 300. So that puts us in the top 1% of firms in the country, because there's about 40,000 firms. We do everything, but what's unique about us as a large firm is that we do more small business and more individual taxation than most small firms. We also have some pretty large clients. We have a payroll processing company that's pretty unique in that we process our own payrolls. And again, we'll get to how that's kind of nice when you're working with a small client, and we can have the CPA and the payroll company in the same company in the same building if we want it that way. We also have a wealth advisory firm, what's called a registered investment advisor. So they don't sell commission products. They sell they do business as a fiduciary, meaning they don't charge commissions. They charge what's called an asset management fee. Typically it's around 1%. So if you have $100,000 invested, they might charge you 1% or $250 a quarter, but then they don't charge for trades, buys or sells or advice. It's all wrapped in there. And so that removes any conflicts of interest, which is a good thing when you're talking about financial advice, of course. And so it's kind of unique to be able to combine those three if you think about running a business between tax, accounting, payroll, and wealth. As we move down, the HR is, so we do everything there from pre-hire to retire, consulting, employee evaluation programs, coaching, things like that. I'll skip over the sales tax one, partially because we just divested of it and started another one. The one that we did start is what's called Savvy Business Brokers. So where that's maybe germane to your industry is that we do partner with some commercial real estate agents. We're not really focused on the real estate itself. What we're focused on is the business. And that company, we have somebody in Appleton and we have somebody in Madison. And really what they do is help people become entrepreneurs or help people exit a small business or medium-sized business. We do property management, so at Real Estate Management Solutions, we do multifamily residential, short-term rentals, or vacation rentals, manufactured home or trailer parks, and then commercial retail distribution and manufacturing. Kind of a sister company that is Secure Storage, which currently manages just under 1 million square feet of self-storage. Right to Evolve is a digital marketing and branding company. Today it's actually, we changed the name, it's called Brand House. So I guess we need to get our own marketing straightened out there and get that caught up. But this slide was developed for a couple of presentations that we did in Madison with KW. And then Go Virtual Office, if you've ever heard of NetSuite, we are a top 10 implementer of NetSuite in the country. We do a lot of, I call everything beyond QuickBooks. So if you know of a small or medium-sized business owner that thinks they have too many spreadsheets in their life or things like that, that's what that company does. But I think what's unique about this is not only the depth that we can cover as it relates to as an agency business that you might have, but also just our basic understanding of real estate. And again, if you run into a real estate transaction and you want our support, we're here for the help. So just see us as a back office. If you're trying to accomplish a 1031 or somebody mentions the word cost seg or 179D or some tax credits or anything like that, just see us as a research guide. And a lot of times we can give you advice that would help you close a deal. So that's maybe where it's valuable. Or again, if you're, one of the things I like about the property management companies is, you know, I want to own a portfolio of real estate, but I don't want it to own me. And so my thought is the money is in putting the deals together and then letting somebody else passively manage it. So I can put my time to my profession, which in my case is being a CPA. In your case, it's transacting real estate for buyers and sellers. And I feel like my best pay grade is optimizing my profession and putting together real estate deals, not managing real estate. And in fact, I would tell you today, I couldn't even come close to the results these people get managing the real estate. And of course, you can imagine the companies are working together. So Brand House is always over helping us with secure storage and, you know, any way that they can work together. We're all inside the same company, inside the same system with walls of, you know, digital security between us. So I think that's good. If anybody, does anybody have any questions on that slide?
Our affiliates have come from client needs that have developed over the years. As we've identified that clients have had certain needs and we found different ways that we could support them, we've kind of matched the need to the client. I see we've got some new people joining us. Thank you so much. We look forward to getting to know everybody here. Feel free to turn on your cameras, turn on your microphones, jump in anytime if you have any comments or questions.
I should mention too, our property management company doesn't list or sell real estate. We just manage it.
It's great.
So
We are also hiring, you know, with so many affiliates and in today's labor market, we are hiring. If you know of anybody or yourself looking for some change of direction or a friend looking for something new, we invite you to recommend our firm. We have on-site and remote hiring opportunities available for the CPA firm as well as most of our affiliates. So feel free to recommend us there.
the one thing I might add there is today we have staff in I think 15 to 20 states and 3 different countries. So it's kind of like it's a boundaryless world now, and we've embraced that, which has allowed us to keep our customer service up, which most of our industry has really struggled with.
So in our conversations today, we've made every effort to compile information that's interesting to everyone and accurate for everyone, but we also want to identify the fact that we can't advise you on any position to take on your tax return or any tax return that we're not actually preparing. Our goal for today is to help give you information that helps you to have dynamic conversations with your tax professional, which we hope becomes us. But even if it's not us, so that you can ask the right questions to make sure that you're uncovering all the stones and opportunities that might be available for you. Today, we're going to talk about the basics, simple things about what you can deduct inside the course of your trade or business. We'll have some time to talk about strategies that you can implement immediately. And we'll likely be able to touch on some current events affecting both the tax world and the real estate industry. In terms of the basics, always knowing what you can and cannot deduct is part of the conversation. Feel free at this point, if you have any questions about, hey, can I deduct this, to chime in. This is a list of some of the common deductions that can be taken by real estate agents. You're deducting your mileage. That's probably one of your biggest expenses. Is anybody here using a mileage tracker app? Anyone want to share what apps they're using?
Everlance.
Best practices? What was that, Patrick?
I use Everlance.
Everlance? Great. Anyone else?
Amber put in the chat, use
Yeah.
Mile IQ.
Mile IQ, yep, that's a good one too. QuickBooks?
Yeah, I use QuickBooks for mine.
Okay. Anybody have any questions about what miles you can deduct? Does anybody know the difference between commuting miles and business miles? iPhone, do you have a question?
If you're going to the office, you can deduct that, correct?
Depends on if you have a qualifying home office. In order to deduct, so the first trip out and the last trip home, that's considered commuting miles. If you work at Walmart, you can't deduct the miles that you drive to and from work. Same thing is true for self-employed people. The first trip out and the last trip home is considered commuting. If you have a qualified home office, that's one of the strategies you can implement to be able to deduct more of your miles, because your primary place of business is inside your home. You don't have commuting miles. It eliminates that first trip out and last trip home. Anybody operating a qualified home office?
Can you review the qualifications for qualified
Sure,
home office?
sure. Yep, absolutely. It's a space in your home that's used both regularly and exclusively for business. It doesn't have to be a separate room, but it has to be an area used regularly and exclusively for business.
And does
I've
the
had-
size of that room make a difference for what you're deducting?
It can lead to the amount of the deduction, but it depends, the strategy of the qualified home office in your industry is probably primarily for the ability to exclude the commuting miles. But also I've had clients I had one client who had a closet that they used regularly and exclusively for business, always storing their inventory inside that space. There was no personal use of that closet. And that allowed a traveling salesperson to deduct all of the miles that they had. So there is no restriction size-wise on how big or small it has to be. There's two different ways to compute the home office deduction. One is the traditional method, which is where we take a percentage of the square footage that's used exclusively for business by the total square footage of the home, and we come up with a percentage. And from that percentage, we're using all of your other expenses to operate your home, your mortgage interest, your property taxes, your utilities, repairs and maintenance, your landscaping, your lawn mowing expense, all those different things times that percentage is used as a business expense. There's no limit on that. You're also allowed to depreciate your home. The other method is the simplified method, which is easier on the record keeping and sometimes works out to be more advantageous. That's a flat amount per square foot. It's $5 per square foot to a maximum deduction of $1,500 per Schedule C or per qualified home office. So those can be pretty valuable deductions. You can see on the slide that there are a few categories that have red flags by them. The red flags are intended to identify categories that may generate a 1099 filing requirement. Does anybody here file 1099s to any other vendors?
I do a bunch of them. I do like 15 a year.
Okay, yep. So those are really important because in the language and technical definition of a trade or business, payments made inside the course of your trade or business that exceed $600 generate a 1099 filing requirement. So you can actually threaten your status as a trade or business. This is more relevant inside the real estate investing space, but you can threaten the status of yourself as a trade or business by not filing your 1099s. You want to treat your business activity as a business. Tim, do you have anything else that you want to add regarding the general business expenses?
One thing I would add is just, I would encourage everybody a lot of this is, whether you decide to use our office for your tax and accounting professional service or use another provider. I always think in terms of you don't know what you don't know, and that makes consuming a professional service like this easy. Or hard. So one of the things I will try and offer today is, as we go through the slides, like, what questions should I be asking? So off of this page, I would tell you, one of the questions I would ask is, should I be doing 1099s? I'll be honest, 4 years ago, 5 years ago, we as a profession kind of laughed off the whole 1099 reporting responsibility. And about 4 or 5 years ago, the IRS quintupled the penalty from $50 per 1099 to $250. And they added 2 lines to every business tax form. Did you file were you required to file 1099s? And did you file the 1099s? Yes or no? When you think about the IRS and who they're going to select for auditing, they can't painlessly add 2 lines to every tax form. That's a lot of programming and printing. And so when they do that, they do it with purpose. And so we feel that if somebody should be sending 1099s, they should take that responsibility more seriously than they used to. Also, just generally thinking about, as you look at the list, like what deductions am I missing today? Mileage is a big deal because it's effectively a non-cash deduction. A lot of the other ones are just easily missed. Home office is a non-cash deduction, but the other ones like business meals, properly substantiating the business meals, cell phones, technology charges, computers, furniture, things like that. Just be thinking about these expenses as you incur them, as are they business related? And sometimes just having a conversation with your provider of what expenses could I possibly be missing?
There's
So-
a question in the chat that says, is there a minimum required use of a home office to be qualifying so long as it's exclusively used for business?
Regularly and exclusively.
So
So there has to be
regularly
some
is not
regularity to it
defined.
also.
Okay.
What,
but
it can't be
regularly.
using it one time a year, and that one time a year is only for business is not qualified use. So I'll take on,
When you
Tim-
bring up the business meals, what are you looking at for that? What qualifies?
any meal that has an underlying business purpose. I mean, I think it's just that simple. So if you are talking to a contact about a listing, that would qualify. If you are entertaining a group, if you have an open house and provide some type of snacks or meals along the way. I don't know that we necessarily do meals, but we certainly do cookies and stuff. Is there a specific context that you have a question about?
I'm wondering if there's like, is there a certain amount that you can deduct off that? Like I went to lunch today on a listing appointment with a client. So is that entire lunch
Yes,
written off?
yes. And so from a substantiation standpoint, what you'd want to do is keep the receipt and
Mhm.
write the name of the client and what it is that you discussed. What was the business purpose of the meeting? To discuss a listing is a sufficient business purpose.
The tip that I would give you here is the credit card statement is not good enough, technically in an audit.
Correct.
So it's
Okay.
the receipt with the name of the person you were with and the purpose for the lunch, and assuming the receipt's got the date and the amount on it.
And
And then
I'm-
Diane, there's just a question in the chat, if you could
I see
answer
that.
that.
Yep. Our business meals still only counted 50% as entertainment. I'm going to clarify the question and pull apart meals and entertainment because those are two separate things. Meals are one category of expense. Entertainment is another category of expense. So entertainment is something like when you buy tickets or take someone out for golf or something like that. You have an entertainment event. Those are no longer deductible. Your tickets you can't deduct that anymore on your taxes. Business meals are not in the entertainment category. They are in their own category. For 2021 and for 2022, 100% of the cost of business meals that are eaten in a restaurant count as a deduction. That changes for 2023. That was a CARES Act COVID related provision. So that ended at the end of 2022.
So would those business meals that you have at lunch, talking about real estate, be then tracked under meals?
Yes.
What would go under advertising?
Advertising would be if you put an ad in a newspaper, or if you put pay any kind of fees to put your listings on Craigslist or any type of publishing service, any type of advertising that you do online within the MLS or with realtor.com or with Zillow, anything that's designed to attract listings or buyers to you, any expense that you incur for that.
What if my closing gifts are logo tagged? Like
Great
I have
question.
a charcuterie board with my logo on it. Is that under advertising or what would that go under?
I would not put that under gifts. Gifts technically have a $25 cap per individual and $35 for a couple. I would call that advertising if I were
Okay.
working on that return.
Thank you.
Great questions.
I think the real question, Mary Beth, is the charcuterie good? Sounds amazing.
It's very good.
I believe it. Awesome.
It's got to be on a personalized board, right?
You got it.
So we'll move on to the next slide, which is common expenses for real estate investors. So this would be, investing in real estate, owning rental property. Your mileage driven to manage your rental properties counts, things like advertising, cleaning and maintenance, commissions, insurance, fees that you pay, management fees, legal fees, interest to service the debt, repairs, supplies, taxes, utilities, and depreciation. Depreciation is a topic that we'll talk about a little bit more. The red flagged items, again, are items that lend themselves to being subject to issuance of 1099s. So I'll kind of tag on to something that Tim was saying earlier about, thinking about the IRS. One of the things that are a current event is the IRS receiving a significant amount of funding. The IRS has been allocated $80 billion to for enforcement and for systems upgrades and things like that. And some of that they definitely need. They're working on computer systems from the 1950s and trying to patch over that system and make it work. And I do a lot of tax resolution work for clients, and I can tell you that their systems are not up to snuff. But if I were the king of the IRS, one of the first things I would do is enforce the 1099 rules, and I would make an awful lot of money in that effort. It would be very, very easy. It's very low hanging fruit. So IRS has been given $80 billion. They are charged with raising an additional $180 billion with that money. And they're coming after every taxpayer, especially self-employed. Someone who has a W-2 from a job doesn't have subjective income that's going on their tax return. It's objective. You report what's on the W-2, it matches, you're good to go. So keep that stuff in mind. Record keeping it's always been important, but I feel like a little bit more effort towards that in this current environment is important. Does anybody have questions about what you can deduct as a landlord? Real estate investor? So a suggestion that we have for you is absolutely no commingling of funds. Keep your business and personal accounts and funds separate from one another. Keep each activity separate from each other activity. If you are dragged into an audit, it will limit the scope of the audit significantly if there's only, a checking account and a credit card to look at instead of your personal account because you're paying expenses from that account, your 3 credit cards because you're mixing business and personal and don't have one designated. Doesn't necessarily have to be in the name of the business, but it should be segregated activity. Does that make sense? That's really important, and it could be tough to do, when you're self-employed, but it's an important step.
I got a question on that.
Yeah.
Let's say your tenants are paying you via Venmo, and there's also personal Venmo, and you take the exact amount of rent they paid you, forward that to your segregated account for the rental property. Is that commingling? Because the Venmo there is kind of commingled.
Technically it is. And let me, we kind of cut this out in order to manage our time, but I'm going to touch base on a topic that you may or may not have heard about on the news, and that is 1099Ks. Has anybody heard of a 1099K? We all get 1099 NEC because we earn commissions, right? We sometimes issue them. Sometimes we get 1099 miscellaneous for rent that we receive. There's a type of a 1099 called 1099K, and that's a payment that comes from a third party network payer. That is like a credit card merchant processor, and it's Venmo, and it's PayPal, and it's Facebook Marketplace, and it's all these different places where people are wirelessly transmitting money and transacting business. The historic filing requirement for a 1099K was $20,000 and 200 transactions. That filing threshold has been changed to $600 and no limit on transactions. So in the situation where you have a Venmo account, Venmo may or may not know what's business and what's personal. And we're not going to know until they actually start coming out. The requirement was suspended for 1 year. So what was supposed to be happening right now is kick down the road to next year. In theory, they're not supposed to mix up the I believe if your tenants are selecting paying a friend Venmo, theoretically, yes. I don't know that we can trust that that's going to be consistent. So I think you still have to be careful about transacting it. I think the official answer would be just keep it separate. Get a separate Venmo account for your business transactions. Even if you put all of your business transactions inside of one Venmo account and then farm them out to the different activities, I think that would be better than inside your same personal account. Tim, do you have comments or thoughts about that at all? You had any feedback from anyone?
Just separation is the key. You know, it's not only helps survive the audit, it helps maintain your what we would used to call your corporate veil, but your LLC veil, your liability protection or shield that you're trying to create.
So a comment from the chat, other events for us that require 1099s, totally agree. Managing a property and forwarding the rents, paying showing agent more than 600 per year. Referral fees also count. Basically, the terminology is payments made in the course of your trade or business that exceed for services in the course of your trade or business are subject to the $600 filing requirement.
I would probably just add too, we believe sending the 1099s substantiates the trade or business language as it relates to qualified business income, which is a major deduction for all of you that I would assume you're getting, and if you're not getting, you sure want to get.
Definitely. How do I issue a 1099? Typically, software is the best way to do it. Your accountant will be able to issue 1099s for you. We just did about 3,500 batches of them last month. I think it's possible to buy the ones that have the carbon in them, but if you only have to issue a couple of them, you're probably going to wind up buying more than what you need. You might be able to get them online as a packet and fill them out by hand yourself. Professionals have to e-file them when you're doing more than, I think, 10. So if it was under 10 and you wanted to handwrite them, IRS won't like it, but I think it's acceptable. Anybody else have questions before we move on? So we're going to shift to our first strategy recommendation, and that is the very simple concept of tax planning. You don't know what you don't know, and tax planning is valuable for many reasons. I think the top 4 is that it shifts you philosophically from a reactive vantage point to a proactive perspective. It also gives you the gift of time. You have time to mitigate an outcome that you don't like. If you find out you owe more than what you want to pay, I mean, we all hate paying the taxes, but we know we have to do it. But it gives you time to implement some strategies, gives you time to raise money to execute those strategies. And it's also an opportunity to interact with your tax professional outside of tax season. Tim and I may or may not have worked over 100 hours a week for 4 to 6 weeks in a row last March. And I like to think we're still pretty sharp doing that. I can certainly say Tim is, but there's a perspective that we have in July when we can really take a fresh look at something, and it's not inside of tax season. Tim, I know you have some thoughts on that too.
Yeah, I would just add too, we just believe that planning increases the taxpayer's understanding, which ultimately brings down the stress. And knowing a little bit ahead of time, you know, if you know in December that you're going to owe $10,000 in April, that's a lot less stressful than finding out April 1st that you got to come up with $10,000 in 15 days. And again, what we have found over the years is everybody's perspective on this is different due to some combination of their personal income, their net worth, their spending habits, and their personalities. You know, some people can owe $100,000 and go, oh, well, that's it. And the next person will get stressed over $500. So it's just, in my mind, there's just no downside to the planning. Every time over years, it's paid off. The other thing that it's allowed us to do is instead of just focusing on this year, we can look at the last couple of years and we can look at the next couple of years. And I tell people, maybe even more important than the tax outcome this year is the tax efficiency over many years. So when you look at the tax brackets, there's an 80% jump between the second and third bracket. There's over a 20% jump between the fourth bracket and the fifth bracket. So these are big jumps. And again, the jumps aren't retroactively, but in some cases, I talked to a prospective client the other day, and actually the message was, we're actually going to start paying more tax because we know in a few years they're going to be paying lots of tax and making lots of income. And today we can recognize $40,000 of income at an 80% less tax because it'll be taxed at 12 instead of 22, which is a big deal. You know, if you could buy something today at an 80% discount that you, instead of buying it 2 years from now, you probably muster up the money and pay 5% interest and save 80% in tax. So it gives us the opportunity to do that when you're proactive. And sometimes it's it's accelerating income, and sometimes it's pushing income out, but it's really about the tax efficiency. That's all.
Long range tax planning. Let's just look at the big picture instead of just put out the fire that's in front of us today. I think a notion of tax planning that comes to light ties in with Ryan's question. Can we talk about any differences or key things to keep in mind between short-term rentals such as Airbnb versus traditional rentals? That's a great question. It's important to properly classify your activities at every level. Every activity can have its own attributes and its own tax determination. In the world of vacation rentals, it is very complex. We could probably do a whole hour just on vacation rentals, but to keep it simple, there's kind of 3 categories. Incidental rental of your real estate would be 14 or fewer days inside of a calendar year. If you rent a property for 14 or fewer nights, you don't have to even report the income on your tax return. Now, if you collect the rental income via Venmo, you're probably going to get a 1099-K, which means you might still be talking to the government about it, but it is not taxable income. So one of the things with them working with our tax team is tax rule number 1, all income from all sources is taxable unless it's specifically excluded by law. So the 14-day rule is one of those rare specific exclusions by law. Category number 2, traditional long-term rental of more than 30 days at a stretch. That is the rental format most people are familiar with. The short-term rentals, when the rentals are less than 30 days, fall into the vacation rental category. And the most important thing to keep track of for a vacation rental is business use nights versus personal use nights. It's pretty complicated proration, and it's applied differently to different types of expenses, but it's driven by the ratio of business use versus personal use. So vacation rentals by nature are a mix of personal use and business use. And there's a criteria that allows or that provides for a limitation of your ability to deduct expenses that exceed your income when personal use exceeds a certain level. So that record keeping is very important. Airbnb transactions are a third-party network payer that will also be issuing 1099-Ks. I'm expecting that when the 1099-K requirement comes out, Tim and I are going to find out a whole bunch of new vacation rentals that our clients may have not mentioned to us in the past, which is exactly what the 1099-K changes is intended to do. Question, if I have a qualified home office and putting new flooring in and painting, is any of that deductible? Yes, if you're using the traditional method, the percentage of business use, which is the ratio of the business space versus the total space, gives you a percentage. So the percentage of your painting and flooring expenses would be a deduction on your taxes. Next strategy, saving for retirement. Tim and I have the privilege of having a wealth management team right under our own roof. So we get to do a lot of creative things in terms of retirement planning that I'm not sure other CPA firms have as many reps with. Tim, is that a fair statement in your opinion? You're on mute.
Yep, it is. We're also well positioned to work with, you know, if you have a financial advisor that you have a good relationship with, or or they're a relative or whatever it might be. You know, we believe because we work with a financial planning firm inside of our company, that just positions us to work with other financial planners better. The easy advantage, there's two easy advantages to bringing it in-house. One, we're connected. And two, when it comes to accountability, there's just no finger pointing because we're on the same team. Ultimately, we can get the same result, whether you use our financial planner or not. It's just that obviously, because they're not connected to us, then we have to charge for our time, and that's a cost. But we're better at it than most CPA firms because we get a lot of practice doing it.
I have two pieces of advice for clients that I think I rank as my top two favorite pieces of advice to give. Number one, anytime you can make money, go make money. You know, people say, I don't want to make money because I'm going to pay so much more in tax. Don't. Anytime you can make money, go make money and call your accountant. The second piece of advice is one of the very best things that you can do for yourself financially is to connect your tax advisor with your financial advisor. There's no substitute for the synergy that can come from having you and your goals, the representation that your financial advisor brings, and the representation that your tax advisor brings. And when you put that triangle together, your ability to achieve your goals and get the most value from all of those relationships is amplified significantly. So
I would give you three questions for your tax advisor off this page. One, am I saving in the right retirement vehicle, whether it's IRA, SEP, solo 401k? I would tell you we are big fans of solo 401ks. We think they are the most underused of any vehicles on that list. If you run a side-by-side comparison with a solo 401k versus the SEP, the simple, and the IRA, it's kind of not a fair race in most situations. Not in all situations. There is no size 12 shoe, which is why you should try to resist getting too much advice off the internet, because it is a little bit customized. The other question you should be asking is Roth versus traditional. There's lots of variables in that discussion. And probably the third question that everybody should be asking, and this is more for your financial advisor than your tax preparer, but I would ask them each to weigh in, is, am I saving enough? You know, and of course, their question is enough for what? Your answer is often retirement. And that just brings more questions. When are you going to retire? What lifestyle are you going to live in retirement? And all of that is a really valuable discussion. And believe it or not, the sooner you have it, the more valuable it is. Because if you think about hitting a target, you know, 30 miles out and you're off, when you're a long ways away, the adjustment you have to make is very small and not really life-changing. When you get really close to that target, if you have to adjust up or down to that target, it can be a lifestyle change, which is also sometimes hard to do. So when you have lots of time, I actually view time as a more valuable asset than money. Most of us think that way as it relates to what we want to do in our lives, but maybe we don't think that way as it relates to our retirement savings. But it's still true. Time is more valuable than money. Now, to retire well, you need to have both. So it's not either or, it's both. And then it's prioritizing them. So that's my comment there.
So just to kind of close, I think if you are self-employed and your tax advisor has told you that you make too much money to put money into a Roth IRA, you need to ask questions about a solo 401k program, because you're not just limited to the 6,000 or 7,000. Opens a whole door to Roth funding using the 401k.
Yep, or backdoor IRAs. There's lots of strategies to get around some of the AGI thresholds for who qualifies for what.
So retirement planning is one strategy to talk about. I think we're moving on to one that ties with Patrick's comment. Patrick made a comment in the chat about the solo 401k limit being 66,000 in 2023. That is true. The other thing is a portion of that is an employer contribution, a portion of that is an employee contribution, and how that turns out on a tax return is pretty interesting. I'm not sure we have time to go into the details of it, but Patrick's comment about setting up an LLC is right on cue. Entity selection is important. Tim, this is one you like to cover.
Yeah, so the first thing I would say here is if you consider yourself a professional agent, you should have an LLC. How we elect to have that LLC taxed is a second discussion. And I would almost even argue that even if you consider yourself what I call a hobby agent, you should still probably have an LLC. Because every one of you in your business is subject to, kind of the almighty close where you just get a holy grail $2 million listing that just comes home and you never saw it coming. The LLC opens up what's called check the box regulations, which basically lets us pick any of these entity types retroactively. So if you think about in business or in taxation, how often you're afforded hindsight in life. Like if I only knew now, if I would have known it then, I might have made a different decision. Actually, with the LLC, you are afforded hindsight vision, which gives your tax professional 20/20 vision as it relates to the outcome. So the thing you have to know is that you can't just flip-flop between the entity types. But in my mind, that's a regular ongoing discussion that you should proactively have with your tax advisor. In just a lot of you guys start out as one member LLCs, sole proprietor, and over time you sometimes move to an S corp when the entity starts earning more than a justifiable wage. And what that does for you is it takes the excess of the income over the justifiable wage and frees it of Social Security tax, which can be up to a 15.3% tax. So.
Questions about that? All right, we've already covered a fair amount related to business use of home, but it could be, the strategy with business use of home is that you're going to pay the expenses to maintain your home anyway. If there's some way that you can conduct your business activity in order to be able to deduct a portion of that or deduct additional miles, that would be a strategy worth pursuing. We've talked about this a fair amount. Does anybody have questions, more questions about the home office deductions? I think we got all the ones out of chat that were in there. Don't forget that there's a simplified method available too. So that would be, as we're looking at what are the questions to talk to the tax advisor about, did you compare the difference between simplified and traditional home office deductions to determine which one's best for me? Depreciation. So that was mentioned in one of the allowable expenses for both a real estate agent or real estate investors activity. The strategy with depreciation comes from making special elections. Depreciation at its simplest form is purchasing an asset that has a useful life of more than a year, and you write off the cost of that asset over a period of time. How much time that is depends on what type of asset. Commercial real estate, for example, is 39 years. Personal property is 5 years. So if you purchase real estate, making the correct classification of what that asset is, and then reviewing what available depreciation deductions are available is important. So if under the context of your realtor activity, you would be eligible to make an election for a Section 179 deduction to accelerate the depreciation and take the expense in the first year the asset is placed in service. Tim, did you have anything to add for that one?
Just in the interest of time, not too much other than this really is, I think oftentimes CPAs make decisions on how we depreciate major assets. And I really think more often than what happens, we should be having a discussion. So again, if you're thinking about discussions or prompting type questions, I should be asking my tax professional when you buy a vehicle or you buy some major asset, maybe you buy an investment rental property. I think you should ask them, how are we going to depreciate that and why?
And that leads into the next category. And again, this is one that Tim likes to talk about. I'm going to read a few questions that are coming in the chat to be ready to answer those when Tim's finished.
So the requirements for the 100% bonus is an interesting discussion because we're in a transition year from 2022 to 2023. Matters if it's considered over the gross vehicle weight of 6,000. Matters if it's SUV or non-SUV. So lots of variables in there. What I would tell you in 22, the write-off rules for accelerating depreciation will be not as good in 23, but still pretty good. So depends on, and I would offer to you, Patrick, I'd be happy to volunteer mine or Diane's time just to talk you through your situation. But if it's a full-size F-150 pickup with a full box, you're gonna write the whole thing off, and you could under bonus or 179. One thing I would look at is another question you could ask. The default right now is to take bonus. We actually think in a lot of times you'd be better off taking section 179 than bonus. Because section 179 applies for federal and state, and bonus only applies for federal. So that's one, and then there's some caveats. You know, it doesn't apply to this phone call, but if you're a manufacturer, you'd rather take bonus than 179. If you're an entity that is paying state tax at the entity level, which some of you high earners might be doing, well, there again, maybe you do, maybe you don't, depending on what you think the tax law might be coming down the road. So quite a bit of variables. With an expedition, I believe you're going to write the whole thing off under bonus, or you'd be subject to a 179 limitation. So a couple of choices there, Patrick. And again, you can take 179 for state and bonus for federal. And if you want to opt out of the bonus and opt into the 179, that's an election that has to be specifically made. I want to answer Mike Weber's question. Does opening a business account for and credit cards for the business LLC differ from opening a personal account? Or is that less of an issue that I'm imagining? Typically, it's the business account itself is just another free business checking or low-cost business checking, depending on where you bank. The credit cards, you know, the reality is most business credit cards, they're going to ask you to personally guarantee anyways. So they're going to put it on your credit. And I don't even care if it's a personal credit card and you just kind of use what I call the red-green mentality, where the green one's business and the red one's personal, and at least I'm tracking them separate. If you feel like it's hard to get a business credit card, just use 2 personal credit cards and don't commingle them.
When you actually go to the bank to open up the LLC account, they're going to want to see 2 things: articles of organization and a copy of the letter where you received the tax ID number. They might ask you for operating agreement. If it's a multi-member LLC, then you'll have to have that. In Wisconsin, we're not required to have an operating agreement with a single member LLC. So you could tell the banker that you don't have one. You're not required to have one. Cost segregation is a topic that kind of falls under depreciation. Cost segregation opens up the door to ask some questions like Tim said. When you purchase a rental property, how do you break apart some of it from commercial real estate 39 years into personal property that you can depreciate over 5 years? That would increase your deductions early on in owning that activity. There's a strategy related to being a real estate professional. That's a specific designation that has criteria involving 750 hours of services in real property trades or business, and more than half of your services that you performed in all trades or business during the year. Rental properties typically are considered to be passive activities, and passive activities have different limitations on how much can be taken as far as losses. There are loss limitations on passive activities. If you qualify as a real estate professional, then your rental activity is not considered to be a passive activity, so you are not limited in your losses. Tim, what would you like to add for that? You're on mute.
I look at this as a great missed opportunity by a lot of real estate professionals. I think you are in the perfect industry, kind of in the Warren Buffett mindset of invest in what you know. You know real estate, and it's not hard for most of you today between long-term rentals and short-term rentals to figure out how you would like to generate passive income in real estate or semi-passive income. But what this rule allows you to do is take losses generated from rental income and deduct it against income produced in your profession. So for instance, if I, as a CPA, go out and have losses due to cost segregation in real estate and depreciation, I cannot take those real estate losses against my CPA income. You are afforded the opportunity to take real estate losses from cost segregation or depreciation on your investments in rental real estate against your commission income. This is like that should just ring. And of course, it's a beautiful thing to have some regular passive income when your industry hits an inevitable down cycle, either because it's been oversupplied by agents or it's being undersupplied by listings or undersupplied by customer demand. I mean, all of those are forces that you don't control, but you do control combining the powerful idea of investing in real estate with the commission incomes. And so it's one of these things when you are experiencing good years of income, you should take some of that income and invest it in real estate, take the depreciation and pay less tax on the years you're earning the good money. So you have some cash flow in the leaner years, so you can stay in the game long term. And again, I think that's part of being a professional is you got to have a plan to stay through the leaner years. And this is how I would do it if I was a real estate professional in some fashion. Everybody's got to figure out their own method.
So we touched a little bit on the qualified business income deduction, kind of moving along because we're down to 5 minutes. QBI is qualified business income that results from an activity that qualifies as a trade or business. So your activity has to qualify as a trade or business in order to qualify for the QBI deduction. That's part of the tie-in with why 1099s are so important, because the definition of the filing requirement for 1099s, payments made for services in the course of your trade or business are subject to this filing requirement. So you can support acting business-like by making sure that you're issuing 1099s along with other behaviors. But the red flag there is again triggering the 1099 conversation that we've already had. The deduction is equal to 20% of your qualified business income. So if you have $100,000 of net profit on your real estate investor or agent activity, 20% of that is not subject to income tax. It's a very powerful deduction. So it's one worth spending some time protecting and keeping your records in a way that allow you to take it. Strategy, we talked about covering, making sure that we're issuing 1099 forms, staying compliant. The penalties, like Tim said, have gone up significantly in the last few years. I think that it's low-hanging fruit when the IRS comes to try to generate their additional $180 billion of revenue. It's very easy to assign penalties. I think Tim and I have both seen less than 10 penalties charged to this point in our career. Mine is almost 30 years. Tim's is probably close, I don't know, longer than that. They have not issued penalties, but they will start. Strategy, don't pay your vendors until after you receive a completed W-9. The information that you need in order to be able to do a 1099 is provided to you on a W-9 form. It's the self-employed version of a W-4 that you fill out when you get a new job. So this is where the vendor is telling you who they are, what their tax ID number is, and what their tax structure is. Some tax structures do not require you to issue 1099s, but you have to get the W-9 form to find out what their tax structure is so that you understand what your filing requirements are. And if you hate everything that I've just said about having to file 1099s, the strategy to outsmart having to issue them at all is to pay your vendors with a credit card. When you pay your vendors with a credit card, you're transferring the responsibility for issuing the 1099s to the people who do the 1099Ks, because the merchant processors have to report that income to the recipient. So one way that you can streamline, it's also a great way to generate miles or cash back or something like that. Pay all your business expenses on a credit card. Prevents you from having the requirement to file the 1099. So therefore, you would be not failing to file 1099s if you in fact made the payments over $600. So we're kind of coming to the end. I'll zoom to the end so I can show our contact information. And if anybody has any questions that they want to cover, we've got a minute or two left. Tim probably has a 3 o'clock meeting. If you want a copy of the slides, I've sent them to Kathleen. There's some information inside the presentation related to energy credits that might be of use to some of you. Information about electric vehicles and some of the new energy provisions that have been put into place. We just don't have enough time inside of an hour to cover all the things that might relate to you. I really enjoyed the opportunity to talk to you today and hope to have the opportunity to work with some of you in the future. Any questions for us?
I think we've been asking questions along the way.
I love that.
Yeah, I don't see anything popping up in chat. Sure appreciate your time and your information. You guys will send out the presentation, and I saw some interesting slides as they flipped by when we were getting to this last slide here. So thank you for your time, attention, and questions. Diane and Tim, thank you so much for your time today. Sure appreciate it.
Our
Thank
pleasure.
you.
Thanks, guys.
Enjoy the day.